What is going on? Welcome on into tonight's stream. Hope you guys are having a great Sunday, great weekend. We are live here as we go deeper into July. It's now mid-July. It's now like I would say the middle of summer. We're getting into the middle of summer trading now, and it's we're full-fledged in it. So as we speak, here's the 1 hour futures on the S&P. As of right now, they have opened up down 0.13%. Off initial readings, off initial trading. Nothing crazy by any means as of now. Going forward and through this stream, what I want to do is I want to set the stage for what we're looking at this week from a macro perspective, and then we'll dive into more micro and more chart focused. I always say that. We always kind of get off topic. I'm going to try to do a better job of keeping myself on topic and ripping through some of the charts. I've got a pretty good list of risk on stocks, if you will. Also have a pretty good list of large caps to watch. We'll try to go through like a large amount of those to kind of gauge where relative strength, weaknesses in the market. I think sectors, we can look at sectors too, to get a good view of all that stuff. So hope you guys are doing great on this fine Sunday. And let's go. So overall, let's start here with the S&P. We'll rip it down through 10-year. We'll look at, dollar, all that stuff. Here's the daily chart on the S&P 500. I mean, we're kind of, I don't want to say we're in no man's land because we're not, but make sure my volume profile is popping through. Volume profile's up. We're good to go. Yes. Volume on the bottom too. Okay, cool. So we're just not there's just not a lot on this chart that you look to the left, you look to the right on the white volume profile, that's got me kind of going, we have clearly, in a gap. We've got a clear target here. The next spot is around 4,600, and even that isn't perfect. I mean, 46 to maybe 4640, which is the high right here. The March high of a late March high of 2022 will be the next spot to watch. I mean, as crazy as it sounds, I think we all can expect and wouldn't be surprised if we get a pullback. But as crazy as it sounds, if these levels break, I mean, we're very likely to test all-time highs and maybe break a new all-time high on the S&P. Whether you like it, believe it or not, doesn't matter. It's the market, right? So that's the look there. However, let's back ourselves up here. Let's talk about the timing, okay? Because you hear that and you're like, oh, this fucking guy talking about all-time highs. Let's relax. Before we start talking about all-time highs, again, the trend is up. You can't fight, don't fight the trend. I mean, you can't argue with the trend being up. However, right, it's pretty extended. It could pull back. Not to mention sentiment is pretty bullish. We've also got fear and greed. Now, also pretty bullish. Now, these are some things that are interesting because they've held up into some of the higher categories of greed and bullishness that we haven't really seen a lot of over the past year, which is not super surprising because the market's been trending down, or it was trending down in 2022, right? So every time we got up, it was a bear market rally. Now that we are in, let's call it a new bull market, as I guess technically speaking, we're up 20% off the lows, so that's classified as a new bull market. Now, how long is it going to last? We'll see, right? If that's the case, we have to understand that if that's now what we're in the bear market, we get up into these extreme greed periods for very short periods of time, then come back. In a bull market, while yes, we can see extreme greed, while yes, we can see a lot of bullish sentiment, right? We have to understand that this is probably going to be skewed and we're going to see more of this than bearish sentiment while the markets continue to trend higher as long as we're in a bull market, right? So that's a piece of the puzzle. I think that makes sense. Again, I think the way to view it, if you were trying to trade the momentum, is if you wanted to, swing trade off the momentum and you didn't have a strategy and you're just kind of riding the trends, ideally, you want to buy pullbacks, right? You don't want to buy extensions. And S&P was technically down on Friday, but barely. So is that a pullback? A couple of days of red is a pullback. A day of barely being down, almost a flat day. Is that a pullback? I don't know. I would say no. NASDAQ, kind of a same deal, broke out to new highs here on the year. I mean, the NASDAQ the chart on the NASDAQ has me looking and saying, I don't see why this can't test all-time highs. eventually, right? Let's see what it does. Maybe it's going to consolidate, mess around for a while, but I don't see why it can't test all-time highs. It broke out of these levels. There really isn't anything insane, until we get to 16,000, then up here towards 16.6, 16.7 will be the all-time high test on the Nas. The Dow looks really interesting. This is actually like if you had to play a sector, right, or not a sector, if you had to play, the Dow, S&P, or the Nas, where do you play right now? What has the best of look? I think the Dow totally does. And if we are in a bull market, right, then you would not expect, but you want to look for that rotation. So you'll have some days and weeks where the S&P or where the NASDAQ will be strong, and the Dow will be strong, and the Russell will be strong, right? So you're kind of looking for that. And right now, you've got a Dow that's just like priming up for the same breakout that we saw on the S&P and the NASDAQ the past couple of weeks. The Dow could be there, and then the Dow probably pops you up towards like 35.5, which would be some of these highs right here. And that would be a logical spot on the Dow. So if one had to say, oh, well, what should you do? How do you play that? Well, I guess DIA is the ETF. It's easier to play. You can look at a Dow or a leverage ETF too. But yeah, the level I'm watching on DIA is like 348. And then I'm going to put an alert there just so I have it, just in case I was interested on this crossing up on the Dow. And then I think that realistically speaking, next target is going to be, I would say around 355 or so on DIA. So from here, it's about $10, but it hasn't technically broken out yet. So you're jumping the gun. Ideally, it needs to break this line to give you like a true confirmed breakout. But all signs point to this looks pretty good. Why? You've got higher lows, and then you've got pressure up into the same resistance level that we've been seeing the past, 6, 8 months now. And, eventually the more pressure, the more tests, the more strength behind the move, the better and the higher chance of a breakout. So that's what we're looking for there. If you had to pick, where do you invest? If you had to be someone said, hey, you have to, for the next 2 weeks, you have to walk away from the screen. You have to be in the Dow, the NASDAQ, or the S&P, or the Russell. I would probably pick the Dow if I had to pick one of them, because the Dow or the Russell, because they're somewhat laggers. IWM is the Russell ETF. It's been pretty strong, and technically it did break out right over this resistance. But, overall, big picture, like it's a big lagger compared to the S&P and the Dow, which I like this chart a lot too, from like more of like a swing investment time scale or time horizon where like, risk reward wise, you've kind of got some higher lows that are building up as of late. And so like, you can have a stop loss or, a stop loss on your position like down into here, but have more of a swing investment, if you will, where, you give it some leeway. You're not looking to play options or give it, tons of risk. But, until the pattern were to break down of these higher lows, this looks pretty good. You also got some lower highs right here. So what you may end up dealing with is more of a coiled up move, and then either we're going to get the coil to break to the downside or break to the upside. And, all signs for now point to the upside, especially with this being a lagger, and especially with a lot of potential money managers being caught in a position where they are overweight individual names or high or tech names, and they're not really overweight, or they have very low exposure towards growth and towards like the higher risk or the risk on stocks. This is where you could see some catch up over the coming weeks. And I don't think it doesn't need to be like may not be very long, but I think there's something there. So that's kind of an overview of what's going on chart wise there. What's going on, Kevin? What's going on, Kyle? DIA looks like an inverse head. Yeah, I mean, that's what, I mean, look at this chart. I like the look. I really do. So maybe there's something there. What is the Dow? Does the Dow have 3x bull Dow Jones? There's got to be a 3x bull Dow Jones, right? Gotta be. Yeah. UDOW, up Dow. That's what you want. What you'd want. You can get the 3x bullish Dow. So UDOW. Is that even a? Let's see. UDOW. Can you play that? Like if I was gonna, yeah, you can. Yeah. So that's an idea. I might do that as a swing trade idea. And then the stop loss for me would probably be right here, these higher lows. I would use the Dow's chart, not the 3x ETF chart, but they're going to be kind of similar. So I would say on the breakout, which is probably going to be over 61 or so on UDAO, the stop loss will be around 56. And then ideally you're looking for, at least a 1-to-1 or better, would be the trade for me. So that's an idea. That's something that I may throw down in the swing account. And it's a strategy I'm testing. I was more so looking to do this on like individual stocks. I wouldn't be opposed to testing it out on the Dow. It's good to get the data. So I'll see if I can add that. If it breaks, I'll add it to my list of, and I'll be testing. I have like a tester account that I'm going to be testing a new strategy from a swing trade perspective. So we'll see. But that might be one that we add to the list here. If you want to play shares, UDAO, and then, options, you can play options on DIA, I guess, would be the better bet. So that's the look. Okay, now let's dive into the VIX. The VIX is just fucking. I mean, VIX broke down underneath. I guess it's important to look at. So let's look at it. The VIX broke down on the trend line, months, weeks and months back. It's still struggling to get back above it. I mean, until it gets over $20, it's tough for me to look at the VIX and go, oh my God. Yes, the risk reward is attractive. However, go and try to figure out how to play the VIX from, swing perspective and go find a very high probability strategy there. It's not as easy as you think. So it's definitely more of a hedge. If you use like leveraged, volatility ETFs, they're pretty tough to play because the decay on those things is nuts. So if you don't get a VIX spike or you don't take profits into a VIX pop, and then we end up going back down lower on the VIX, you're going to get bled out like you're kind of seeing on people who have potentially played that. If you look at like a UVXY, which I believe just did a reverse stock split, right? Look at UVXY. UVXY is back at new lows, even though the VIX technically isn't at new lows. It's the decay. It had a nice pop. Don't get me wrong. Like it popped from 1840s up to 22. So it's volatile. Like if you wanted to hedge and you timed it right, like it could be good on shares. But again, you got to time it right. And if you don't time it right, you could be in, let's say you get in right now at 1735. This could be at $10 before you know it, right? For all we know. And then that's down a fat chunk of a percent. So just keep that in mind. The 10-year, which I think is more interesting to look at. So here is where my eyes are focused. I got a lot of lines. Let me just kind of dissect the lines. Why are there a bunch of lines? Well, first off, we've got these downtrending lines as kind of our channel that we've got bigger picture. I added a bunch of just lines here just as levels. So first line right here is around 3.7, 3.69 or so. If we break below 3.69 on the 10-year, that is, in my view, on yields, that is not a good look. That looks bearish on yields, bullish on bonds. So like TOT would be, bullish. And that, I don't want to say confirms, but based off of what I see, that's like a false breakout. That's a false breakout. So you have this break. It was like 2-3 days, and then it said, whoop, sorry. And if this week we just did this, that would not look good. And I would suspect that we could be targeting, sub 350 on yields. I think is very doable. 325, maybe even 3.15 could be a reach target, which would be down towards the bottom end of this channel. That's a reach, but over the course of months, maybe that's where we go, right? So that's the look that I'm looking at. Another piece to watch is Truflation. I think this could be they kind of can go hand in hand. So if we take a peek at Truflation, I refresh this bad boy. So let's look at the past 6 months. So what you'll see in the past 6 months is that this is trying to do a better job. There you go. Than like the CPI readings that we get. They're trying to be a little more accurate, more up to date versus some of the lags and stuff that you'll see in the CPI readings. So far, we've been trending this way. I think there is concern that we're going to bounce a bit over the next couple inflation readings. And I think you're kind of seeing that to a degree, maybe through the past. Like it's not accelerating to the downside as fast as we saw back from February into, March timeframe. And then back from like late April through June, we saw some pretty big moves down in the CPI or the Truflation rate, right? Now it's starting to kind of consolidate, if you will. So looking for, the bigger play, this thing goes under 2 and then it starts to get a little, I don't want to say concerning, but it starts to get interesting. We're setting up in about a week and a half to get a Fed hike. That's like very much baked in right now. The Fed is going to hike. Will it be the last hike? We've been saying that for a while, and every time we say that, I feel like we end up coming back, and a couple weeks later, we're like, well, looks like we're going to hike again. That's just kind of where we're at. Although this is starting to get pretty interesting, because if this ends up being semi-accurate to CPI, it's telling us that right now we're like, the Fed's done their job. They're good. If the Fed just stops here and they're done, and the problem is that there's still lags, and so those lags are going to keep playing out. There's a good chance we're going to see a sub 2% CPI at some point. Headline, maybe not core yet. That's up in the air. We'll see what happens with core. That's around 4. I came in at 4.8 last reading. So that's why it kind of goes hand in hand with yields, because the lower these inflation numbers come in, the you would think, right, the lower this could go, as it could be pricing in more cuts, and whatnot, or cuts coming sooner and whatnot. So that's the look there. Next is the dollar DXY underneath $100, which 175, 180 or so was $100.88 or 85 cents or so was the breakdown, and we broke down below that, and now that does not look bullish, although I think we have to somewhat suspect retestability. So like, will this come back up into here and then do something like this? That's like a big question that I would have on DXY. Or will it just continue to accelerate to the downside, or will it come back and back test this break and then go? I don't know. A big move there. So I would not be surprised if you get a back test, and I also would not be surprised if you see some sort of chill out on metals, or where maybe see more consolidation or a little bit of a pullback on metals. Why? I mean, silver more so than gold. Gold didn't move that much last week. It popped a bit, but nothing insane. Silver had a massive move. I mean, silver within 2-3 days, really it was 2 days, is like very close to the highs of the year. Not very. I mean, it's about $1.25 away from the highs of the year, like that. So I mean, you got a big move on silver, and yeah, it's like I would say you have more like back test potential on silver than gold, but we'll see what happens there. And then Bitcoin, because we're talking the dollar, Bitcoin versus the dollar here, is just in consolidation. I think we're going to get a break here eventually, but again, you don't know which way, you don't know what's going to happen. So I'm not going to sit here and say that, yeah, it's going to happen. So load the boat. I mean, who knows? It looks pretty good. If you ask me, it looks pretty good. It looks very good to the upside, but again, no way to know for sure. What you've got is this nice wedge consolidation, broke to the upside, didn't really get a huge move. Now we're consolidating again. It's been about 3 weeks of consolidation. These consolidations have taken, more than a couple of weeks, maybe actually a couple of months, and then it pops. So maybe we get more of a consolidation here before the next pop. I'm targeting on the next pop, if we get it, 37.5, and then breakdown level around 25K. If we lose 25K, not a good look. I think we see downside from there, just from a chart perspective. Again, news could be news, but I like to just look at the charts, because the charts, generally speaking, will take the news how they want to take the news, and they're going to do what they're going to do. So the news, you can back your way into the news all you want and try to understand the news all you want, but I don't think it's that important. I don't think it matters as much as everyone tries to back the news into a lot of these moves. I just don't think it matters. Oil. So we had a nice move up. It broke out of this consolidation or this downtrend, actually. I guess bigger picture, bring it on back. I mean, we're still in a downtrend, right? Generally speaking. And we had oil that did that too. It had this kind of, these highs right here. We broke above that and then fell off. So, but this looks pretty good. Big move off the lows, held the lows nicely. Triple bottom, if you will, and then popped through, broke this 75. I like that. Now it's back around 75. Maybe it's a back test. I would like, if oil is going to stay bullish, I would like to see it kind of pull back in somewhere in here and curl up and start to push back up. But maybe it's a false move, and maybe it's going to set up for another, push back down. I don't know, but oil has not been the most volatile as of the past couple of months, really since this year began. It's gotten some movement, but nothing insane. Generally speaking, has been between 83 and 67, so about a $16 range for the entirety of the past 8 months, which, It's a big range, I guess, but given how much oil's moved over the past couple of years, it's okay. It's nothing to be, going crazy about in the grand scheme. Got some decent support down in the mid to low 60s. I would suspect if we came down there, you get a bounce. And then I think the bigger break of the downtrend, in my opinion, is going to be around 83. If we break 83, okay, boom. Now we can pretty much say, hey, oil's trending up, whether you like it or not. That's what price is doing. Higher lows, looking for higher lows, looking for dip buys if you wanted to get long oil. That said, I'm going to rip through some other comments in a second. That said, I did want to pull up. I just noticed this last week. ExxonMobil was pretty weak. So you saw that move on oil, right? Exxon had this insane relative strength compared to the market and compared to oil even, because ExxonMobil technically hit an all-time high back in April when like oil was downtrending for months, like 6 months of downtrending, or more, maybe more than that, maybe a year of downtrending. But it just broke below a pretty nice level around 101. It just broke below that on Friday. So I was like, whoa, what's going on here? If this is not a little kind of, if oil, doesn't matter. I shouldn't even say that. Either way, just chart-wise, if this doesn't catch some buyers back up in the coming weeks or days, I would suspect a target to watch is down around 98 on ExxonMobil. And I don't want to get too excited below or get too antsy, but below 98, I mean, I don't know. It could drop more. So I would suspect or think a catalyst for that would be oil, or a potential supporting argument would be oil has to stay weak for that to really happen. But just some levels I'm watching. They do have earnings coming up on the 28th. So the last full week of July is all earnings. And then that Friday, a lot of oil stocks, a lot of earnings. So SPACs had some of the wildest moves. We're all those days on Thursday. EDTX, CTCX. Nothing worth watching on Monday. Let's take a look. CTCX for Monday. Oh, coming out or watch on Monday after the big moves of late last week. Let's go to Millen. Got to catch our stream, of course. Stream back TMF, adding more TFW for breakdown. Yeah, I would say back on this 10-year, not to get super into that whole thing. I don't want to say I loaded the boat. I have enough. Is what I would say. I have enough, but I hear you on the TMF. My plan on TMF is I have it. I'm going to most likely look to start to sell a covered call on it soon, and then maybe we can get if we get this breakdown below here, I would be selling a covered call for sure, because that would probably lead to a nice move on TMF, which is the 3x TLT. We'll see. TOTW, it's just tough to not want to be there, to be honest, and not have to worry too much, which is the buy right bond DTF. So essentially, it's TLT on steroids. You'll get a decent, if TLT is making big moves, you'll catch a decent chunk of the move, and you're getting paid a monthly dividend, which is pretty good. As of last dividend, they paid 53 cents a share. The month before that, they paid 35. Month before that, 53. So, I mean, there's some nice dividends to get paid out. Before that, they paid 64. And this is volatile. This dividend is volatile. It's, just be careful. But it's something to think about. To not have to worry, to get that TLT exposure and not have to worry. So that's what I would say on that bad boy. So I forgot to do silver. The thing with silver, though, is that you could probably get a decent, if it pulls back, you could probably get an SLV. You could probably get a decent little sliver of the pie, right? On SLV. This is SLB. SLV. Oh, here it is. Yeah, so ideally on SLV, these are massive gaps. Pulls back into here, okay, maybe. And then if it even pulls back into here, even better, to get in. And then, of course, you can have a stop loss below here, right, on the trade, So that's the thought. I have a AGQ 33, which is a leverage silver ETF. So I have a 33 covered call that expires this Friday. It kind of worked out that it's going to end up it's up around that spot going into, the end, the expiration week. I'm hopeful that I can get out. When I say that hopeful I can get out, I mean, I hope that it kind of pushes up over 33 and then just takes me out. Because then what I'll look for is in any weakness. And if I still want, and maybe I don't want to get that silver exposure. I'll have to just kind of think back or reassess the portfolio and say, what do I want? What am I underweight to? Where do I see the best risk rewards? And maybe it's not silver or gold. Maybe it's in growth. I don't fucking know. Something like that. That like I'm like, you know what? I want to get out of this and go into this and play it this way and get a dividend here or something like that. I think that the reality, I have a video that I just kind of went off and explained the mindset, but is after decent runs, I think what the past couple of years have taught me is to be much more defensive. And hey, we could go a lot higher, but even being defensive, you're still going to capture, a good chunk of that. You'll get there. You won't have the FOMO. You also won't have the excessive risk, right? And so getting out of the leverage plays, getting into the more dividend plays, the monthly dividend plays, even though they can go down and we can be down a lot on those, the monthly dividend mitigates some of that risk and minimizes the downside, right? And so it's a little bit less risky, if you will. And so you're at least putting your money to work if we keep going, because there's no way to know, are we going to keep going or not, right? You're putting your money to work, but at the same time, you're managing the backside. So you're going to keep the gains that you've made, right? And this way you're not going to screw yourself on the backside. And I'm also going to be hedged, right? So that said, I think I bought an SQQQ hedge last week, on Friday, literally on Friday. So I'm in there. I'll probably hold it for, unless, hey, if the market pulls back decently this week, I'll get out of it. I don't really care. I'll sell it and then hold cash and just chill for, a bit and see what I want to do. Not like I'm in the, need to immediately just deploy, go into heavy margin and be like all maxed out. No. If it pulls back, if SQs, go back up to 20 plus, I'll get out, I'll get out. Cause at this point in time, I'm not looking for the hammer. I'm not looking to get into SQs for, the hammer down to like, new lows. That's not the intention. The intention is to hedge, as we get overextend. And also it's more so peace of mind. I'm gonna be on vacation for a week. So ideally I'll hold it through that. But hey, if the move happens, if we get a big move this week to the downside, I'll likely will take off the majority of it and move on. So we'll see. But that's what I did. We'll see what happens there. So what is going on here? Silver's beast. Oil's pulling back so far in futures. I'm going to bet on drop more. Wouldn't be surprised. Russell's short right now in futes. Let's check it out. Do I have it? No, I don't have it pulled up on my charts. But let's see it. Oil and futures are looking like. And yeah, oil, I think we can. I would suspect oil can. I would like to see what oil does in here. I want to see what oil does in here. If oil comes into this area, 74, maybe upper 73s, see what it does. If it falls right through, not a great look. But if it can bounce, that could be a good look to the upside on oil. JPST if you want ultra safety. Yeah, I don't think that's a bad idea at all. BGLC is a network one uplisting set for tomorrow. Same other underwriter as ATXG. That move from 13 to 1200, that's insane. That's a good list. That is a solid list. 400% runners at their debut. 400 runners plus. MEGL was nuts. I remember that one. That was a beast. I'll cover call portfolio. That's the way I'm going to play in the long. That's the thing. I think that like reality, is that they're really here's my as you kind of get maybe it's in getting older and I'm realizing that and just more experience, you get older and you realize I could compound with safe. Of course, nothing is guaranteed, right? But more safety and more security. When you get into random companies, that are not individual stocks, you have more risk there, right? When you go into an ETF, there's less individual risk, and also it's no, stocks don't just get into an ETF like by accident, right? Generally speaking. So you have a little more like legitimacy to the companies that you're investing in or that you're getting exposure to. So I like playing the sector macro view, right? Like I call it like the macro swing. Like for example, like TLT, is an amazing, in my view, an amazing recession hedge. And also potentially just a decent swing trade. Doesn't mean that even if we don't go into a massive recession, like TLT, for all we know, could go from, $100 maybe to like 120 over the next year or two, if, rates eventually kind of come back down. And like that could be a great 20% like macro swing, if you will. And then once you kind of get to a point where you're starting to look out, and the risk reward is now skewed, where the risk reward from holding this position no longer is as attractive as it once was, and then there's other opportunities elsewhere, you lock the gains and you move on, because TLT, in my opinion, isn't a long-term investment. TOT, like, yeah, you could, but like TLT realistically is more of like a vehicle to swing trade and to play off the volatility and the cycles that we see in the economy and the cycles that we see in rates. That's what you're doing. You're not playing TLT, for the long run. This is a great company. It's like, no, it's not a company. Like, you know what I'm saying? Like, it's not like that. So that's like, and then take and roll that back into your like ultimate strategy of just dollar cost averaging and getting, cash flow and whatnot. And so if you can roll that back into the dividend ETFs and just dollar cost averaging into stocks and stuff that you want, then you can have, or growth, right? Then you can have like a nice compounding portfolio ultimately. I think the mindset has shifted for sure over the years. So it's like the get rich slow method, but like almost like, I won't say nothing's guaranteed, but almost a guaranteed way to get rich if you do it nice and slow, versus the try to get rich quick. And then now the game becomes all the things that you did to get rich quick through the risky investments, right? Through, whatever swing trades or day trades or whatever, you did, or getting lucky on betting all in on, a stock, right? Doing that, or those types of things, it's extremely difficult to break those habits and then to stop doing that stuff, to preserve the wealth and to preserve the gains that you've made. I'm a perfect example of experiencing that over the past, over the years, right? You go through good spans and then you have learned all of these things that they may have worked, but they don't work all the time in the long term. And so now you have the experience to say, hey, here's when I can push the pace, I can push the pedal down a little bit, maybe go a little on the margin during these times, during when we see these things aligning. And then when we see these things start to play out and we start to see the risk reward be no longer attractive, we start to get out of margin, we start to be more defensive and start to kind of just get those dividends, sell covered calls, lock in some gains, hold some more cash maybe, and then just and have some hedges and let the dollar cost average approach and just the compound get rich slow method do its job. There's no rush, right? Because again, I think that's a big piece of it. Protecting the backside is everyone always says, risk management. You think, oh, fuck that. Who cares? If I can make a ton of money now, what does it matter? Well, no, it does, because you can make a ton of money and then you can lose half of it or you can lose all of it. And what if you were able to preserve 90% of it instead? Would be pretty cool, because the next cycle that you nail it and you have a good run, and the next good positive cycle for whatever you're invested in, now you got, an even higher starting point to go for more, right? So EBOE. What's EBOE? You're talking about on our YouTube? I don't know. EOSE, sorry. EOSE. Let's check out that weekly. Let's go to the weekly chart first. Give her a minute to load up. Interesting. Doesn't look, it's got some nice higher lows, don't get me wrong. It got extended for a bit up as it got up over 570. Then it came back. So it's got a better risk reward now. Yeah, you'd want to see it. I would want to see it do this. Find some support here. So I would like to see it hold $3, ideally. I don't know much about it. It's got some good volume as of late. Volume is coming in. You got some more volume down here. So it's just good to see. Pull back here. Now let's see if it holds this prior resistance and make that support around $3. That'll be cool. So as it gets down under 350, you want to see it start to kind of back test and hold. Maybe start to bounce soon. I'm a fan of covered calls and cash puts. I mean, hey, I'm telling you, I really, as you have more of an understanding, it's not, the thing that's really cool is from here, I think that's something that can really distinguish you and set you apart from the average everyday passive investor, to now like just a little bit better, which then can compound massively over your lifespan, right? Or over your investing career. So like, as this is what I start to get into, this whole like longevity thing. But like, think about this, as people start to live longer and longer and longer, I think investing is even that much more important, and having like a cash flow or just a compound interest method, right? Because when you're like, my view is like, when you turn 50, 60, 70, people start to say, okay, well, it's can't do what I used to be able to do as a young kid, right? And but that's when you have the most money. That's when you have accumulated the most wealth. That's when now your 10% per year is large amounts of money, potentially more than you were making as your salary, right? Just by doing nothing, by just sitting there and jerking around, like literally, like. Or maybe it's making more. Ideally, it's making more. It's offshooting more, and then you sell covered calls. You go to other, like you can make so much. You can make so much on your nest egg, but then it becomes a game of like, well, now I can't even do anything. You got to go to your kids, which is totally fine. Nothing wrong with that. But I think especially like this generation, we don't know, as you push the bounds, as we push up into those years, like what's going to happen when we're 75. People who are in their, 20s, 30s now, even younger, right? When we're 75 plus, if you take care of your health, like you could be very much alive, well, and active, and use that money, man. Like, don't like, that's what I think is that's a huge like piece that I don't think anyone thinks about, or not many people think about, but like, that's big because you have compound interest on your side. So waiting an extra couple of years to kind of get rich slow isn't as painful as it may have been when, oh, well, I'm going to die at 65 anyway, or not. You get the point, right? Which I think makes it even more important for people to take care of their health so that they're around to reap the rewards, or at least some of the rewards of what they built over a lifetime. Because you can do some major, major damage. In terms of building a good portfolio, not damage. I mean, you can do good, is what I mean. The reality is that most people making money from options are sellers. Yeah, I think 100%. 100%. Like that's why, I mean, as much as like the options are great, like the reality is that you want to build positions, sell covered calls. If your portfolio does 8% per year, or let's say you're just in SPY, let's say you just had SPY, right? But you sold covered calls you sold way out the money covered calls against your position. Well, SPY pays you a dividend of 1.64%. If SPY averages 8% per year, of course, no year does 8%. It's much more volatile than that. But it averages 8% per year, for example. But then you sell covered calls that gets you to 10% per year. So now all of a sudden you go from a return of like 8 to 10 to maybe that 10 to 12 potentially. And now you're sitting back like, oh, but that doesn't sound like a lot, but compound that for 10 years, for 15 years, it's a completely different ballpark. If you compound that for 10, 15 years, it's a different game. You're in a different realm, which is nuts. Yield Max needs to hurry up with other ETFs. Yeah, they're probably going to come ripping out with some more of them. For those who don't know, check them out. Yield Max ETFs. This is like not by no means sponsored at all. Some pretty nutty distribution rates. Essentially, their dividends they're paying you, which is nuts. I mean, Tesla's a crazy one. OARK is an interesting one as well. Nvidia obviously has done nuts. Yeah, let's check out NVDY's chart. NVDY. It's funny. Look at this thing because it's funny because it hasn't like broken out because Nvidia is just going so hard. But what is this dividend? This dividend was almost $1 a share. They paid in July. Yeah. Like a week and a half ago, literally, they paid a dividend of 90, or their payment date is tomorrow. But on the ex-dividend date was Friday, the 7th. So a week and a half ago, they literally dropped a bomb of almost $1 a share. If you had, it's a $23 stock, it's not like this is an insane thing. I don't know, had 100 shares. You had 100 shares, you made $100. Like, that's pretty cool. For only a $2,000 or $2,300 investment, you get $100 cash flow that month. Whoa. Go back to June, paid 75 cents a share. Same thing. $75 that month on just 100 shares, It's pretty freaking cool, right? Obviously, right? You're missing out on the appreciation of Nvidia. So NVDA, has done better percentage-wise, but does Nvidia pay you, a fat dividend like that every month? No. So that's what's pretty cool about it when you think back, when you look at these ETFs. And of course, you're getting that. What you want in a perfect world, what you actually want is you want a nice, slow grinder up. That's how you'll capitalize on some of the nice premiums, and you'll also capitalize on, the dividends and whatnot. But hey, you get some big moves. Doesn't matter. You get these big volatile moves. You have these volatile, juicy, option premiums. You're going to get paid good dividend checks is what you're going to get paid. So I don't know about you, but it's pretty cool. NASDAQ will be rebalancing on July 24th. The FANG weight will be reduced. Yeah, I'm curious if the market will react in a big way to that. I did see that a couple of days ago. And I'm glad they should. They should totally reduce the weights to the massive tech stocks. Completely agree. Time is on our side. I think 100%. So let's say you had, looking back, right? If I knew what I knew now, and again, I think you have to kind of go through that to get to that point. If I knew what I knew now, right? Post COVID. Now, of course, it was very easy to get caught up in this. And if I knew what I knew now, there's a pretty good chance that I would have missed some of the rally of the COVID market on some of the stocks. Would I have shorted it? No, I would not have shorted it. I would not have shorted an uptrend, but I probably wouldn't have been partaking as large as I did on some of the rallies that we saw there. I would have gotten more defensive, which still would have done okay. I would have gotten more defensive into that. So I don't know. Well, my view, as I've said in the past, again, if you care or not, I want to look at some stocks now here in a second. But my view is simple. SPY 500 plus this year, I sell everything, or at least I trim largely out of most stuff. Any individual or any stock equity position exposure, I'll be out of. I just have no interest. I would have no interest. The risk reward would make absolutely no sense to me anymore. And so I'd be out now. Nothing wrong with maybe leaving a little bit of the dividend ETFs on there. Maybe just holding, but at the same time, I think back, you know what? They're going to pay me, a couple percent. If rates are still high, they're going to pay me a couple percent cash on my cash. I'm going to hold cash, get my couple percent for the rest of the year, and just relax. Although at the same time, I say that now, there's probably going to be other sectors. You don't have to necessarily play SPY. Maybe that you want to go to the oil. You want to go to oil. Maybe you want to go to, metals. Maybe you want to go to bonds. I don't know if everything is going to be sold because, of course, doesn't necessarily mean everything. But if we go 500 plus on SPY this year, which means we have less than 6 months to do it, right? That's about the time to do it. No, I'm not interested. That would be in this past year, it'd be a massive move. Unprecedented type of move. We haven't really you go back in history, you don't really get many of those. And also, do they all hold up and last? No, things will eventually settle back down. So that's a time where I would say, to me, the money could be put into other investments. It could be used to pay down debt. And it's like a time to, your risk reward becomes much greater. For example, let's say you had a car payment. In my view, let's say that's what I want to do. I want to buy a car. We go that high. I'm like, hey, I want to pull out some money to buy a car. Or let's say I had a car payment and I want to pay my car off. Well, if I'm paying a couple $100 a month, Now I think now you're talking I think it's a nutty number. I think it might. I don't think it's the average. Is it the average? Average car payment per month. I think it's. I want to say I saw some nutty numbers. Yeah. Here you go. So as of right now, Texas is where I live. Right. Average new car payment is almost $600 a month. So let's say you did well, or you have the risk reward becomes stupid to the point where I don't see good risk reward in stocks. I might want to take out some of the gains or take out some gains and pay my car, because now what does it do? Well, now I potentially will free up $500 on average, right? $600 a month, because if I can pay the car off, or obviously maybe you don't pay the whole thing, whatever, pay the car off. This is an example of kind of just being, I think, smart about what's going on. It could be a student loan. It could be this. It could be that. It doesn't matter. It could be anything. But if you can do that, shed down your monthly payments, or now that monthly payment goes into your pocket or now goes into your investment account, well, then you can build up a bigger cash position. You can build it right back up, and then you can be right back in the game. So it comes down to kind of weighing things out, right? What's the best risk reward for you? And to me, that's where I would start contemplating other things. I would be contemplating, right? Is there something that I could pay off? Is there something that I could buy elsewhere that can get me a better return on investment without the risk right now? And that's where maybe holding cash or paying off debts would be the best, in my opinion, thing to do up there. That's hindsight after, now being through, right, some of this. You can start to see that. And that's, of course, not necessarily financial advice. I mean, do whatever you want to do. But that's something that I would look to do. 15-20% portfolio me compound. Dude, think of this. A 15 to 20% portfolio that can consistently do that and compound at that rate consistently. I mean, that's not to let's just look it up. Let's see. So you start with 10K. 10K every month. I don't know. So let's say drop $100 a month. This is nothing insane. I don't know, 20 years. Let's just do 10 years. 10 years for now. Interest rate, let's do 15%. Just say we're getting a crazy rate. Let's just go compound annually. 10K turns to 64K in 10 years with only depositing $100 a month. Now, maybe you can deposit more. Maybe you can deposit, I don't know, right? Do the math on 20 years. Again, it's where it becomes insane, right? 20 years, 286K. Again, if you're 20 something years old, dude, you're going to be 40 years old, 45 years old, right? 48 years old, whatever the year is. If this is what you started with, when you're 48, and of course, you might have a job that now pays you a lot more and you can deposit $500 a month. Maybe you can deposit $1,000 a month at some point. The game becomes insane. Dude, dare you get to 20%? I mean, I don't even want to do the numbers. It's going to be nuts. $600,000 at a 10K investment 20 years later with a 20% average. Now, of course, that's every year 20%. That's a lot, right? But of course, the math is insane either way, right? So, yeah, I mean, it's again, dude. Even if you just simply, got the 10% per year, for 20 years, right? 10K turns into $136,000 on an average of 10% return. And this is, again, might not sound like a lot, but let's say you up your monthly contribution to $250 a month on average over the course of that 20-year span. 136 turns into 239. Boom. Right? So compound interest, obviously, a lot of us already are well aware of what it can do, but that's where a game gets pretty fun. TSLY, same thing, mind-blowing. Well, let's look at TSLY. TSLY dividends. So TSLY is the Tesla Yield Max ETF. Now, you would capture some good gain on the appreciation over the past month or so. Yeah, you would be up a decent amount. In the past month, the thing is up 10+%, which is cool, right? So you're up 10% on your position. But you would have captured this July dividend, which if we pull it up, what did it pull? Over $1. I mean, this is nuts. Over $1 a share. TSLY is under $20. You only throw at TSLY $1,700, and now you had this month, you're getting paid an additional $100. Nuts. It's not gonna be forever, but nuts. The June dividend, 80 cents. The May dividend, 44. April, 82. March, 90. Feb, 90. Like, you want to get Tesla exposure without a lot with some minimized risk? Kind of cool. But you also got to understand that you are, with these ETFs, you're there for the downside. So you ideally you'd want the stock to go up. Ideally you don't want it to go up too fast, but pullbacks from these levels are pretty attractive. Or it's a risky game, or play the game of, I don't know, buy them for the ex-dividend date, sell them after. I don't know. People do that stuff. I'm curious. I've seen mixed reviews on the realities of that, and then many times there'll be reactions around those dates. Like, for example, ex-dividend date was the 7th of July. On the 7th of July, you had a massive gap down from 1820s down to 1720s. Did Tesla gap down on the 7th of July? What did Tesla do? Tesla, it was down that day, but, down from 276 down to 268, So that's what you'll get on those ex-dividend dates. Everyone plays for those sometimes. $10% on a million is $100K, more than most people. Yeah, no, 100%. Like, you build a portfolio to $1 million, right? Your 10% per year is $100,000. That's why I think one of the most powerful things is to build a portfolio into the 100,000s as early as possible, because then you start playing that game where you're young, right? You're probably still working. You're probably still having active income that's paying the bills. And then you can take those huge those larger dollar returns and then just completely send them back into the machine and just rebuy or just continue to dollar cost average into more shares, while you're also still, investing money from your active income into your portfolio. So you have this like even bigger snowball that can just be blowing up, which is insane. And that's where, I think the reality of most people's minds should be. The past couple of years has skewed everyone to where they think they can get insane returns, in the shortest amount of time. And you totally could, but, I don't know. I think that if you're playing it smart, you have a piece of the pie dedicated to being more active, and then you have a decent piece of the pie that's pretty passive, dollar cost average, reinvest dividends, and just run that wheel and play the game. It's how the yield max ETFs to the index weights on QQQ and SPY anchor with SPY SPYI, which is the S&P, I think, covered call ETF. JEPI or JEPQ with some TOTW. Ooh, that is a nice one. That, as of right now, that would be nice. Do you have an HSA, a health savings? Not as of right now. Trim in and out of the yield max if you anticipate downside. Well, what you can do is one of the strategies would be short. What is the TS? What is it? TSLL? Is it TSLL? Yeah. So what you can do is into really strong moves in like these stocks. What you'd want to do is you'd want to short the leverage bullish ETFs as a hedge. So let's say Tesla goes on a massive run and you're like, oh shit, like, I just want to protect my backside here. You could buy you could buy a put on this out like a couple of months And then that could be your hedge, on that. So that's the way to do it. Because if you want to short, like the most effective way to short Tesla would be to short the leverage bullish ETFs, realistically. So that's what you'd want to do. Triple tax advantage. If you max out your HSA early, you can turn into $1 million retirement account. Use it for medical. It's tax-free money. Dude, I'm at a point like where I'm starting to like, I have to start being smarter about stuff like that. Absolutely. No, that's something that I'll keep that I should definitely look into now. I definitely should. Alrighty. All right, let's look at some charts and then I will send us off. So, SMH, first bad boy. I'm going to go through the sector ETFs first and then individual stocks. We also got Tesla and we have Netflix on Wednesday. Tesla and Netflix on Wednesday earnings. SMH popped an all-time high on Friday, then fell back off. So potentially some backfill targets, 154 and then 152. We'll see what happens. That really breaks down below here. I'd be concerned about a break in trend, or I'd be more, willing to talk about a break in trend. Breaks down below here. Yeah, that's definitely looking like a break in trend. So we'll see if we get one of those breaks. That is on SMH, the semiconductor ETF. XLE, kind of weak. It did look, or does have a very similar look to oil, but a little bit weaker. I will note that. And I think a big piece to that is ExxonMobil, which we talked about at the beginning, is to blame for that to a degree. XLI, this thing is, breaking out to new highs. This is new all-time high, I believe. Let's go to the weekly chart. Yeah, new all-time high on XLI. It looks good. Stair-stepping, doing its thing. If it back tests 104, cool. Would like to see it hold that level now going forward. But it's got, a lot of leeway to get there. XLF, it's coming back. This is actually pretty interesting how XLF is bouncing back. 35 could be the next target to watch on XLF. KRE is the regional banking ETF. A lot more upside potentially here, but a lot more potential concern with the Fed continuing to hike rates. So to me, not a huge interest. Really, this is like your zone, up through 45 is the spot to watch. If it breaks back above 45, could be a nice upside trade into the 50s. That XLV had a nice pop there. It's coiled up like a freaking, I don't even know. It's really coiled up. So I think an XLV above 133 is a nice break to the upside setup. Below 126 is downside break. So here's the two levels I'll be watching. Those are the two spots that, we're closer to the upside here, but then the downside. On top of that, mRNA is your short on this bad boy. It's been weak as hell. Look at that mRNA. Again, if it rallies up, though, wouldn't short it. But if it doesn't rally through that level and doesn't break to the upside, mRNA, man, oh my God. The fattened pig is just slowly bleeding. The thing of this is what I think about when you step back and look at like an NVIDIA move. Like, here's where I would just say relax. Like, if you are a bear, or you're like, yo, NVIDIA freaking sucks. This company is so overvalued. I want to short it. You've been getting you've been getting destroyed the entire way up. We had a new all-time high on Friday. Get fucked. That's what's happening. But you just have to relax. The setups will come on the backside. Let it go crazy. Once everyone is kind of suckered in, you're going to have that much more of a move to come down and break down. So everybody bought mRNA. When? Here. And then look at this volume spike here. A lot of volume in here. Guess what? These people are underwater. And guess what? We're coming for them next. The market's coming for them next and coming for these guys next. Who knows where this thing ends up, but over the course of the next couple of months to years, would not surprise me to see mRNA just kind of slowly bleeding itself back off. And it wouldn't surprise me if it was back down into here. Wouldn't surprise. Slow. Again, though, waiting for backside to establish. Right now, you look at the stock, it's like clearly downtrending. You have got no upside momentum at all. Every time it goes up, every time the past couple of days, look at these weekly charts. Look at these little wicks. Every single week, it's weak, it's weak, it's weak. Every wick is selling off the past couple of weeks. Look at this. All of these upper wicks, all selling off, all downtrending, all lower lows, right? So eventually, you get a break. You get a break of a pattern. You get a break of a support. When a break of support comes, you got a momentum move. Now you get a momentum move that could send mRNA from 115 to $100, maybe even below $100 in a relatively short period of time. Maybe it's a couple of weeks, a couple of months, right? Stop loss above like 125, 120, maybe 130, something like that, and that's it. But you're waiting for the backside. So like NVIDIA could totally be a beast. Like if we have a massive recession and holy crap, everything is a mess and like, oh my God, guess what? And everything starts to contract again. Guess what? NVIDIA's price to sales, NVIDIA's like all these things are going to come back to somewhat of a reality. And guess what? That'll be awesome. But right now, you're fighting a beast. You're fighting a beast. I don't care, but like, it's just not, I've been that guy, tried to do it, tried to be buying the dip into here and here and here. And I also gotten fucked there too. You got to wait for a better opportunity, wait for a better setup, wait for when you have momentum on your side. And that's at least one more thing to check off the box that you don't have to worry about. So this is like, everyone gets all into this stuff and it's like, oh my God, NVIDIA. Yeah, like it's not a buy. Would I buy it up here? No. But would I short it up here? Also, no. Doesn't make sense. Doesn't make sense. Because just because you think it's overvalued, guess what everyone was saying back here, back here, back here, right? Doesn't matter. People were saying that back here, and it went to here. So it doesn't matter. It doesn't matter. It's just let the cycle play out, let the ups and downs. Once it starts to establish clearly lower highs on the weekly time frames, okay, now we can start to say, okay, there we got some better risk rewards in the downside here. Can we put together, a plan to capitalize on it? Just not shorting into the strength. It just doesn't make sense. Maybe it's just some people they like, and I used to be that guy. I just think that it makes, from a trading perspective, and it makes no sense. Makes no sense. XLV and XLU are coiling nice. J&J is up to J&J. Johnny and Johnson. Yeah, it's coiling up. Higher lows, lower highs on Johnny. Johnny J. My computer's being slow as hell for now, whatever reason. Yeah, I mean, this is tightening up. So you're going to get a break of one way right now. Really, I'd mark this is the two spots I'd mark. Right? Very similar to DXY. It's the same thing. It's the same chart pattern idea, whatever. Same thing as DXY, right? What did DXY do, right? DXY was downtrending, then it did this. Pretty big moves. Okay, coiling up, and then boom, eventually broke, right? Broke this level, downside. It could have done the exact same thing on the upside. It could have broke this level and then broke this level if it just did this. It could have done that too, but it didn't. It did the opposite. So it doesn't. The setup, I think, is more so about the pattern, the chart, and instead of trying to guess which way, it's more so about waiting for it to tell you which way. And then you got better risk reward. LLY and Merck are strength. Yeah, let's see. So if we get the break to the upside in XLV, right? Yeah. Look at Eli Lilly, dude. That's a pretty strong freaking stock. Yeah. Not an insane, I don't know if I love that chart, but strong. Merck was strong on Friday, but generally speaking, it's been strong, but not as strong. Yeah. LLY, I think, is the best looking chart, or at least better. Because it's got a shorter. Yeah. This higher low is May. So, realistically, your levels to watch. I'd put it here, and then I put it here. These highs, right? Pretty expensive stock, but that's what I would look at. All right. XLP. This is consumer staples. Just kind of chopping it back up, tightening it's just coiling up too. It's also been a pretty range-bound stock or ETF since. XRT, been relatively weak. This is retail as it loads. Give it a second. I got a million tabs up. Maybe I should kill some tabs. Probably will do that. Killing some tabs here. XRT, man, I don't know. Not much to me. It looked decent, back in here, back in May, June, as in breaking to the downside. But I don't know. The weakest stock, I think, in retail is TGT. It's Target. I think it's not even close. This is the beast. Not beast. This is the downside play. So give it a second to load because my computer is being a pain. That's probably telling me to start to sign off here. TGT, come on. Give it to us here. Any day. Either TradingView is being a pain or it's on my computer. Which, I don't know, man. I got this bad boy loaded up with some RAM. So she is freaking... she's locked and loaded. Pop a new tab here and see what we got. Okay, there's Target. There she is. There she is. Look at this chart. This is a chart. This is a nice chart, in my opinion. You got a freaking beauty on Target here, I think. I mean, all it's done is just show weakness. Like upper wicks, like not able to get back up over this prior support. So if we are going to pull back in the markets, right? If Target couldn't have bounced in the past couple of weeks with the strength that we saw, what's going to happen if the market kind of has a dip for a couple of days or for a week or two? You would suspect you're going to get a nice move down. Again, could be wrong, but from a short perspective, Target looks like a juicy short opportunity. So that's our chart there. Let's cover the last two here, which will be Tesla and Netflix. Tesla up here at highs of the year on the weekly. Next spot I'm looking at is 315. I think that's the spot. It's like, I think as crazy as it sounds, I think we can see, 250 or below. And I think we can see 315 or 300 plus if this earnings is good or bad, right? Or however the reaction is off the earnings. So chart looks good. Like Tesla looks like a decent long if it breaks out above 285 this week. But I mean, earnings is on Wednesday. Take it with a grain of salt if it does break out, right? Careful. Netflix, kind of same deal. Netflix is sitting here just underneath a massive gap. If you had to ask me what I would like to see, again, who cares? But like, I would like to see it kind of take a hit on earnings, pull back a bit, then build a higher low and at some point over time, and then eventually come back and fill this gap if it's going to do it. Ideally, like it's just, if it goes, it can go to like 500, in like off the earnings. And it's like, okay, well, I'm not touching that. Like you're not going to trade that off the earnings. I just think it's too volatile. So we'll see. The hub is slowing the PC. Yeah. Yeah. The hub in the background. Geez, my 20 tabs of the hub. Oh, UTME has been trading stranger the past week. Reminds me of how it topped the stream before it squeezed, gets hammered down, low twos every time. Tries to break 260. Let's take a look at it. Yeah, that does look kind of weird. But it has that feel of like, yeah, no, this volume was pretty nuts the past couple of days too. Yeah, I mean, you would think the $2 will be the stop area, and ideally, right, but it's kind of a decent risk. That could be a beast. That volume is telling, though. I think the volume is really nice on UTME. It is. All right, guys. With that said, I'm going to wrap things up. It is now 9 p.m. my time, and it's almost time for bed. I've been hitting one thing that I will say. I don't know if it's been. I don't wear anything to sleep, like like a Whoop or whatever, or my watch. I could wear the Apple Watch to sleep, but I don't. I probably should. I just think it'd be annoying because I got the Ultra, so it's like a big bitch. But I like to start tracking my sleep. But one thing I've been doing before bed is like 10 minutes of stretching. Oh my God! Like I don't know if it's just. Maybe it's helping me fall asleep faster, but like I feel like I go down fast. 10 minutes of stretching, hop into bed, and your body is just like, oh, you're out like that. So that's my recommendation. If you haven't tried it, try it out. With that said, thanks so much for watching. We'll have a stream on Monday, Wednesday, Friday this week, and I'll be pacing out on Saturday, and I'm back next Sunday for a stream, hopefully. So See you guys this week. Let's go. Peace out.